Welcome to this explainer. Today, we're diving into what is honestly one of the most fascinating paradoxes in the market right now. We're talking about Alphabet, a tech titan that currently finds itself sitting right at this critical $342 support level. And the signals coming from the market, well, they're entirely at odds with each other. On one hand, we're looking at exploding AI infrastructure costs and some, frankly, very notable insider selling. But on the other hand, Wall Street is just pounding the table with strong buy ratings. It's a massive crossroads, and we are going to break down exactly what it all means for you.
So, this brings us to the central question we really have to answer today. Is Alphabet actually a buy at $342? The contrast here is stark, and honestly, it's a little dizzying. Some fundamental metrics are flashing bright red, suggesting the stock might be as much as 35% overvalued right now. But if you look across the aisle, you've got top-tier analysts projecting a 25% upside from this exact price point. So, who's right?
Okay, let's look at our roadmap for today. We'll cover the valuation debate, the bull case, the bear case, the technical make-or-break levels, and finally, wrap it up with the final verdict. Starting off with Section 1, the valuation debate, conflicting signals.
First, let's look at the raw numbers here because we've got a massive juxtaposition. The GF value metric calculates Alphabet's fair value at just $254. If that's accurate, buying in at $342 means you're paying a hefty 35% premium with a very, very thin margin of safety. But then, Wall Street's Analyst consensus has a target on the stock of $428, suggesting massive unrealized upside. I mean, that is a gigantic gap.
And to complicate things even further, take a look at this number, 17.4x. That is Alphabet's trailing price-to-earnings ratio right now. What makes this so interesting is that it's noticeably below the company's 5-year median PE of 24x. So how are we supposed to interpret this? Well, the market is either actively pricing in sluggish, slower growth ahead, or, and this is a big or, it's currently offering us a relative bargain while it waits for earnings to catch up.
So it really boils down to this idea of a quality premium. When you buy Alphabet at $342, you are undeniably paying a premium over some of those baseline metrics. But are you simply paying a justified premium for what might arguably be the absolute best AI ecosystem in the world? Let's look at the arguments for why that premium might actually be worth every penny.
Moving to Section 2, the bull case, 3 drivers for growth. The bulls out there are leaning on 3 distinct, highly powerful pillars to justify buying in at these levels. First, the incredible acceleration of Google Cloud. Second, the global expansion of their autonomous driving division, Waymo. And third, the looming catalyst of their next-generation AI model, Gemini 4. Let's break these down one by one.
Starting with the cloud. Google Cloud isn't just growing, it's accelerating, boasting an absolutely incredible 63% year-over-year revenue growth. But what's even more fascinating is what's happening under the hood. Morgan Stanley recently flagged Alphabet's custom TPU chip business, which is their specialized hardware for AI processing, as this massive hidden gem. They're projecting that TPU sales alone could add billions to the bottom line by late 2026. So this isn't just a software play anymore. They're cornering the hardware infrastructure too.
Then we have Waymo. You know, for years, Wall Street viewed Waymo as just a really expensive science project. Well, not anymore. They're currently rolling out over 3,200 Zeekr autonomous vehicles right here in the US, and they've already slated an international expansion into Munich for 2027. Waymo is rapidly transitioning into a highly visible, revenue-generating global moat that competitors are seriously struggling to catch up with.
And the third pillar of this bull case is Gemini 4. Look, in the fast-paced AI arms race, perception is almost as important as the product. The upcoming launch of Gemini 4 is poised to be a major narrative shift just waiting to happen. If it delivers, it could firmly reassert Google's undeniable leadership in artificial intelligence, totally silencing the critics who claim they've fallen behind the startups.
Now, let's flip the coin for Section 3, the bear case, 3 looming risks.
Because just like the bulls, the bears have 3 distinct pillars holding up their argument against buying at $342. They are pointing to a massive AI capital expenditure squeeze, some very concerning insider selling trends, and dark antitrust headwinds. Let's examine these a bit closer.
First up, this number is just staggering. $200 billion. That's roughly the scale of the AI infrastructure spend Alphabet is currently committed to. To put that into perspective, you could literally buy a few small countries for that price. Building the future of AI is aggressively expensive, and this massive capital expenditure is currently crushing their free cash flow margins. The bear argument here is simple but terrifying. If consumer and enterprise demand for AI doesn't materialize exactly as projected, this $200 billion spend is going to be a massive financial drag on the company for years.
And look at what the people inside the actual building think. Over the past year, we have seen over $160 million in insider sales. And insider buys? Zero. Nothing at all. Now, sure, insiders sell for all sorts of reasons. Buying a house, paying taxes, maybe picking up a private island. But the old saying absolutely holds true. Insiders know their own business best. A complete lack of buying is a signal you just cannot ignore. Finally, we cannot forget the regulatory overhang. The ongoing Department of Justice antitrust case is a major dark cloud over the stock right now. The bears are quick to remind us that any worst-case breakup scenario wouldn't just be a little bump in the road. It would entirely reset the valuation framework of the company from the ground up. It introduces a level of existential risk that frankly makes a premium valuation pretty hard to stomach.
Which brings us to Section 4, Technical Make or Break, the immediate chart.
Technically speaking, Alphabet is hovering at a crucial make-or-break juncture. Our key support zone is exactly where we are right now, between $340 and $345. If the stock breaks below this floor, analysts warn it could plummet down to $328, or even retest lows around $315. Alternatively, key resistance is sitting tightly right above us at $349 to $352. A confident break above that ceiling, that signals a strong bullish reversal. Now, what makes this specific technical setup so explosive is that the stock is currently coiled up in a very tight trading range, and it's doing so on remarkably thin trading volume. And, when volume is thin, it means the market is basically holding its breath. It means that any sudden news, whether it's an unexpected Gemini announcement, a surprise in the upcoming earnings, or just a random shift in the broader macro environment, could trigger a very sharp, aggressive move in either direction.
All right, bringing it all home with Section 5. The final verdict, actionable takeaways.
So, what do you actually do? Well, what's really interesting here is that we can map out precise, tailored strategies depending on exactly what kind of investor you are. If you're an aggressive growth investor, the play here is to buy, but use a strict stop loss just below that $340 support level. Your target is $420, and you're treating this as a pure high-conviction play on AI monetization. Now, if you're more of a conservative or value investor, the data suggests you should probably hold off. Look for a better entry at $315 or lower, or simply wait safely on the sidelines until there's undeniable proof that this massive AI CapEx is actually translating into earnings per share. And finally, for current holders, the smartest move is likely to hold, but set tight stops. It's a fantastic, high-quality company, but at this exact price, the risk-reward is completely symmetrical. To bring it all together, my final take based on these sources is basically this. Alphabet's fundamentals remain absolutely elite. Their execution is incredibly strong across both cloud and Waymo. But at $342, you are simply not getting a massive discount. Ultimately, you're paying fair value for a great company, and honestly, that is perfectly okay provided you have the patience of a 3 to 5 year time horizon.
And that leaves us with the most critical question of all to wrap up this explainer. What is your time horizon? Before you make a move at this $342 crossroads, I highly encourage you to do your own research. Make sure you size your positions appropriately and deeply factor in your own patience. The roadmap is laid out right in front of you. Good luck out there.